Today, I'll be covering 6 of the best and most popular investment portfolio strategies, and since I started my channel, this has been one of the most requested video topics, so I'm super excited to dig into this with you today. And I'll be covering strategies that range from very simple to slightly more complex, so wherever you are in your investment journey, you'll find something that could work for you. And throughout this video, I'll be using various Fidelity index funds as examples, but for a more comprehensive list of Fidelity index funds that you could consider adding to your investment portfolio, click the link in the description box below to download a free copy of my Fidelity index fund guide. Now let's get into it. The first strategy is called the one fund strategy, and this is really as simple and as basic as investing could get. And there are two main ways that you could go about doing this. The first is to purchase one single target date fund, or you could alternatively select one single standard index fund that is a total market fund. A target date fund is really optimal for long-term investing, like investing for retirement, because this one fund has a mix of stocks and bonds, and as you reach closer to retirement age, the allocation automatically shifts from growth-oriented to more conservative. So you don't have to do any portfolio rebalancing on your own. That all happens automatically. So this strategy is really more of a set it and forget it type of strategy. And to pick a target date fund, you'll want to pick a fund that is closest to the year that you plan to retire in. For example, if you're currently 30 years old and you plan to retire at age 65, then your retirement year is 2058. So you could go ahead and pick a target date fund like this Fidelity 2055 Freedom Fund. And there's a lot more that I could go into about target date funds, but for the purposes of this video, I'll stop right here. Let me know in the comments down below if you'd be interested in a full video on target date funds in the future. The next option for building a one fund portfolio is to just choose one standard single total market index fund like FSKAX, for example. FSKAX is a total US stock market index fund that is very low cost and consists of almost 4,000 holdings. So essentially with this fund, you would own a tiny piece of every single public company in the United States. And choosing to go with one fund like FSKAX versus a target date fund is definitely a little more risky since you're missing out on that diversification piece that target date funds bring in with bonds. But if you're a younger investor who is willing to take on more risk, then this strategy could definitely be an option for you. Next is the two fund portfolio strategy, and to apply this strategy, John Bogle, who is the founder of the Vanguard Group, suggests one total US stock market fund and one US bond fund. For example, your portfolio could consist of FSKAX as the total stock market fund and FXNAX as the bond fund. And then as far as allocation between the stock and bond funds, Bogle suggests 4 different options, 2 of which are heavier on the stock allocation side, with 80% in stocks, 20% in bonds, or 60% in stocks and 40% in bonds. And then he also suggests 2 which are heavier on the bond side, so 40% in stocks, 60% in bonds, or 20% in stocks, 80% in bonds. The general rule of thumb with investing is to hold more of your money in stocks while you're younger and then gradually shift to holding more in bonds as you age. So for example, if you choose to go with this strategy, you could start off with holding 80% in stocks, 20% in bonds, and then as you near closer to retirement age, gradually rebalance your portfolio so that eventually you do reach that 20% in stocks, 80% in bonds. Let's move on to the 3-fund portfolio. The 3-fund portfolio consists of one domestic stock index fund, one international stock index fund, and one bond index fund. For example, your portfolio could consist of FSKAX as your domestic stock fund, FSPSX as your international stock fund, and FXNAX as your bond fund. And this 3-fund portfolio approach is designed to be a holistic take on diversification, because you're not just getting US stocks in your portfolio, but you're really balancing it out with mixing in international and bond funds. For the allocation between stocks and bonds, this is really just dependent on your personal preferences and your risk tolerance. And once again, while you're younger, an 80-20 split between stocks and bonds is reasonable, but you could also do 100 minus your age, and whatever that number is would be your allocation towards stocks, and then the remainder would be your allocation toward bonds. So this is really customizable to whatever you want. You just want to keep in mind your preferences, your risk tolerance, and your goals. Before I continue on, if you're getting value from this video so far, please hit the thumbs up button and subscribe to my channel for more personal finance content. Now let's get back into the video. The next strategy comes from someone that you've likely heard of, and you either may really like him or really dislike him, and that is the one and only Dave Ramsey. So you've probably heard of Dave Ramsey's Financial Baby Steps, or maybe you've listened to his finance podcast, but Dave recommends building a portfolio that is equally divided between 4 different types of mutual funds: growth and income, growth, aggressive growth, and international. And Dave describes growth and income funds as large cap US based companies, growth funds as mid-cap stocks from US companies that are still on the rise, aggressive growth as the wild card since these companies have a lot of potential, but there is still a lot of risk that comes with them, and then mixing in international funds. If you do choose to go with this strategy, just keep in mind that mutual funds do have some downsides that index funds do not have, such as mutual funds tend to be more expensive. They have a higher expense ratio since they are actively managed. So before pursuing this strategy, I recommend that you do your research on mutual funds to make sure you understand what you're investing in. And I even have a video on my channel describing the differences between mutual funds, index funds, and ETFs. And I'll leave that video linked in the description box below so you can check that one out after you're done watching this. Now let's talk about 2 portfolio types that fall under what I'm going to call the Ivy strategy. And these asset allocation strategies seek to mimic the portfolios used by Ivy League institutions to grow their endowments. And the 2 such strategies that I want to talk about today are the Ivy 5 and the Yale Model. The Ivy 5 consists of 1 total US stock market fund, 1 global international stock market fund, 1 US total bond fund, 1 diversified commodities fund, and 1 US REITs fund. And the allocation between these 5 funds is evenly split, with 20% being allocated to each. An example portfolio could be FSKAX as a total US stock market fund, FTIHX as a global international fund, FXNAX as the bond fund, FFGCX as the commodities fund, and FSRNX as the real estate fund. The next Ivy strategy method is to use David Swenson's strategy, which is called the Yale Model. David Swenson was the president and chief investment officer of the Yale Endowment Portfolio for over 30 years. And he invented what is called the Yale Model, and he used that strategy to outperform the S&P 500 by almost 3%, which is just very impressive, during the time when he was overseeing Yale's endowment. The Yale Model consists of 6 different funds with an allocation as follows: 30% in a total US stock market fund, 15% in an international stock fund, 5% in an emerging markets fund, 15% in intermediate treasury bonds, 15% in inflation protected bonds, and 20% in US REITs. An example portfolio could consist of FSKAX as the total US stock market fund, FSPSX for international, FP80X for emerging markets, FUAMX for intermediate treasury bonds, FIPDX for inflation protected bonds, and FSRNX for real estate. I also want to note that the percentage allocation for the Yale Model is not fixed. You can always adjust the percentage allocated to each one of these funds to fit your personal preferences and your risk tolerance. don't feel that once you pick a strategy that now you have to stick with that strategy for like the rest of your life. You can always shift and adjust later on. For me personally, I started off with a target date fund because I was new to investing and I didn't want to get in over my head or start doing things that I didn't really understand. But as I've learned and I've grown in my investment knowledge, I've since shifted away from that one fund strategy. And you can certainly do the same. Just start off where you're comfortable, and then as you learn more, you can always adjust if you want to do that. The important part is to just start and start as soon as possible. Now, if you're looking for some Fidelity index funds to add to your investment portfolio, click the video on the screen to hear about 5 of the best Fidelity index funds to buy this year. Thanks for watching.